Good morning. Welcome to Market Monday. We hope you enjoyed some good commercials last night during the Super Bowl, where it now costs $7 million on average for a 30-second spot, up from just $37,500 going back to 1966. This is one place we do not expect inflation to cool off anytime soon. Well, here we are about a month and a half into the year, and so far 2023 has been kinder to both stock and bond investors. But before we call the all clear, we've been here before. The rally since bottoming in October is similar to the June through August rally, both up right around 17%.
And despite the approximately 17% rally since the October lows, that still leaves us about 12% down from the all-time high for the S&P 500. That begs the question, after market drawdowns, how long does it take to come back to former highs?
Here, we're looking at a timeline down here starting in 1950 through now. And here is the number of market days without reaching the prior high. For reference, there are about 250 market days in a year, compared to 365 calendar days. Let's start with 200 days, which is where we are in this current bear market. 200 days is about 9 months when you exclude days that the market is closed. By our count, there were 15 other bear markets that took at least 200 days to reach the prior highs. As a reminder, the prior high was achieved on January 4th of last year, so we're already over a year, hence approaching 300 market days right here.
Obviously, the 2008 financial crisis was bad, bottoming on March 9th, 2009, and not reclaiming the 2007 high until 2013. The dot-com crash was also brutal, the market itself being down 3 years in a row, taking about 7.5 years to regain the prior high, only to be followed a couple years later by the global financial crisis, producing the infamous lost decade of the early 2000s. While we can't know for certain what lies ahead, markets don't stay down forever and are very rarely down even 2 years in a row. As investors, the best we can do is stack the odds in our favor as much as possible and stick to our plan through thick and thin.
Well, you may have seen the news about the unemployment rate last week, pretty darn low at 3.4%. In fact, you have to go all the way back to May of 1968, all the way back here to see 3.4% unemployment, which is great. But again, not so fast. Unemployment is always low prior to recessions. That is a feature of recessions, rising unemployment. See here a dozen recessions and the unemployment rate prior to the recession start. And look at this, the number of months from that trough until the recession starts. So that means we had relatively low unemployment and then up to 10, 11 months later, over a year in the late 80s before the recession actually begins. The problem now is that this information is right in front of us every day. So we all sort of know the playbook. And sitting and waiting, will it or won't it happen, with all this other stuff going on, is a challenge we work with and contend with every day.
Should we show them another prediction gone wrong? Are you tired of predictions gone wrong? Well, one more for the time being. We've picked on JP Morgan enough and the Federal Reserve last week with predictions of soft landings in 2007. Here we have a guy named David Rosenberg on February 6th, just last week, calling for stocks to drop 30% from here. And don't even think about becoming bullish until next year. Don't even think about it. And of course, here's the same Rosenberg, then Merrill Lynch's chief economist, in April 2009, less than 1 month after the bottom, marking one of the greatest bull markets in history. Are you out of your mind? Again, anybody making predictions will be wrong, but if you're condescending about it, we're going to call that out.
We hope you enjoyed this week's video. Have a great week.